Welcome to another episode of Taking Stock for the week ending the 29th of May 2026. I'm Ken Trent, Head of Research at Stock Doctor, and joining me today is our Senior Portfolio Manager, Matthew Swartz. Matt, can't believe the month of May has just gone by so quick.
Yeah, it's whizzed by, hasn't it, Ken? It's very volatile in markets at the moment, but it's great to be joining you again.
Yeah, you never know what to believe that's going on in the Middle East. But even before we begin, just a reminder that today's discussion is general in nature and won't consider your personal financial circumstances. Remember, also, we have the Sydney and Melbourne Masterclass event next month where we'll take investors on a journey to strengthen their portfolio construction process by applying strategies using shares, ETFs, property, and alternative investments. So make sure you sign up if you haven't done so. But Matt, markets remain quite volatile, as you mentioned, as investors digested Australia's largest inflation data alongside this whipsawing of outcomes in the Middle East. We don't even know what to believe anymore. But that April CPI report that showed annual inflation easing to around 4.2% from 4.6% previously, but the underlying inflation measures remain quite sticky.
Yeah, I think that's correct, Ken. The key number the market focused on was the trim mean inflation, which the RBA, and that is their preferred measure, because it strips out all the volatile items, and that actually rose to 3.4% from 3.2, remaining well above the RBA's 2 to 3 target range. So the broader message was that inflation pressures across services, insurance, and labour-intensive sectors are still proving difficult to bring down.
Yeah, that's going to be a hard decision for the RBA. But at the same time, also, I noticed US inflation increase at its fastest pace in 3 years in April. And the market's anticipating now that the Fed Reserve could hold interest rates unchanged well into next year in the US.
And that's why markets are becoming less confident around interest rates, with bond yields remaining quite elevated. And this is compounding the weakness across growth stocks, which have previously been impacted by this whole AI disruption thematic.
Yeah, that's right, Matt. And speaking about growth stocks and interest rates also, a star growth stock that is quite sensitive to that thematic is Australia's dominant property classifieds business, REA Group. The share price has been under a lot of pressure over the year, despite earnings holding up quite well, undergoing Rule 3 there.
Yeah, so initially I think the weakness began after CoStar increased its investment in Domain, but investors started questioning whether a global classifieds giant with substantial capital could intensify competition across Australian online property advertising over time.
Yeah, and the market then shifted its focus towards that AI thematic, where there were growing concerns that AI could eventually disrupt how consumers search for properties and how agents market their listings, potentially weakening the pricing power that online portals like REA have historically enjoyed.
And more recently, though, the concerns have become increasingly tied to housing market conditions themselves. Auction clearance rates across Sydney and Melbourne have softened quite noticeably, and listings growth has become less consistent. And policy decisions around negative gearing and capital gains concessions have raised concerns around future investor activity in housing.
Yeah, there's so many risks there that investors should be mindful of because REA's earnings are not directly linked to rising property prices. It's about those transaction activities, listing volumes, and premium advertising spend from agents. So if turnover begins to slow here meaningfully, that can ultimately impact their earnings growth.
And another key point here, Keen, is that short interest is rising above 5%, and it also suggests that market is becoming somewhat more cautious around downgrade risks. Investors appear worried that weaker housing conditions could reduce listing depth, while also making it harder for REA to continue pushing through strong price increases to the agents.
Yeah, that's right. And historically, REA does benefit from that strong pricing power. You've got premium agent products as well. And then also you've got a relatively resilient listing activity. But several assumptions are now being tested, and that's competition and the sustainability of that pricing growth, housing transaction volumes, and broader property market sentiment. So understanding these risks are quite important there, huh?
They are. And, especially as we sort of head into the full year reporting season, make sure you manage your exposures until there is further visibility in the outlook and listing volumes.
And for under the microscope this week, let's turn to Fisher and Paykel Healthcare, one of the few healthcare companies that has managed to navigate the recent sector-wide downgrade cycle relatively well. And Matt, for investors less familiar with the business, and I know a lot of people might, link this company to the appliance maker Fisher and Paykel, but it's actually quite different. What exactly does Fisher and Paykel do here?
Yeah, so Fisher and Paykel essentially makes products that help patients breathe more comfortably. In hospitals, its equipment is widely used to deliver warm, humidified oxygen to patients with respiratory issues, while hospitals regularly reorder many of the consumable components, creating this recurring revenue stream. And the company also sells masks and accessories for sleep apnea treatment used at home.
Yeah, that seems awfully similar to also ResMed. So a lot of investors may be wondering what's the difference between this company and ResMed. Well, ResMed is much more heavily focused on sleep apnea devices, masks, and also patient monitoring software used in the home. Whereas Fisher and Paykel, they still derive a large portion of their earnings from hospital respiratory care, which tends to provide more stable demand.
Yeah, that it does, Ken. And unlike Cochlear, which has faced weaker implant demand and surgery delays, or CSL, which has dealt with plasma pricing pressures and execution issues, Fisher and Paykel has benefited from steady recurring demand from hospitals globally.
Yeah, that's very important there because a large portion of their revenue comes from consumables. That's products hospitals repeatedly purchase rather than once-off equipment sales. And that reduces sensitivity to weaker consumer conditions or delays in elective procedures as well.
Correct, Ken. And operational execution has been quite strong. Last year, investors were concerned that US tariff risks, higher freight costs, and supply chain disruptions could pressure margins across the healthcare sector.
Mm.
But Fisher and Paykel managed this really well. Its manufacturing footprint across New Zealand and Mexico gave the company that flexibility to shift production and reduce exposure to tariff-sensitive US supply routes. And it's improved delivery times and better managing its inventory, while selectively passing through price increases where demand remained quite strong.
Yeah, and that latest result highlighted that resilience as well. You got return on equity that's currently at 22% and margins held up better than expected despite broader weakness across that healthcare sector.
Yeah, the numbers look quite strong, Ken, and the earnings are expected to grow in the double digits over the next couple of years. Aging populations, rising respiratory illness treatments, increasing adoption of high flow oxygen therapies, and continued product innovation will continue to support growth.
And now for question of the week. Today, we're focusing on the growth cycle. It's clearly been a painful period for the sector with tech and healthcare stocks underperforming. So you can really see this with that chart on screen, which shows the growth versus value ratio in blue. And you can also compare that to interest rates in orange and grey there. But you can see how that ratio has actually fallen over the last few months. So the question now is, what signs should investors look for to indicate that the growth cycle may begin to recover?
Yeah, really good question, Ken. And look, growth stocks tend to perform best when bond yields fall and economic conditions are quite stable. But due to their high valuation multiples, they are sensitive to economic conditions and rising interest rate environments.
Yeah, that's right. But meanwhile, we're in quite the opposite environment. You've got rising inflation, higher bond yields, and weakening economic growth. And this tends to favor those more defensive or value-orientated sectors, including those cyclicals as well.
And look, the first signals investors should watch for is bond yield stabilizing. If inflation continues easing and markets gain confidence that interest rates have peaked, valuation pressures across growth stocks should begin moderating.
Yeah, and also given that growth stocks tend to be more exposed globally as well, investors should look for the US dollar as well, especially if that US dollar starts to strengthen. That could support revenue generated in the US, especially for those that have a cost base in Australia.
Correct, Ken. And look, at a fundamental level, investors should pay attention to the earnings revisions. Companies delivering results or trading updates with guidance at least in line with expectations suggest stabilization.
Yeah, definitely. And let's not forget changing sentiment among those fund managers as well. A few growth stocks currently have moderate levels of that short interest. So if this trend begins to fall, it is usually a sign that a turnaround could be on the cards. And just like, for instance, you look at WiseTech, Pro Medicus, and even Zero, for instance. And but that brings us to the end of this week's episode of Taking Stock, Matt. Thanks again for your insights. I know how busy you are.
No, it's always a pleasure joining you, Keen. And look, if you do know somebody who would benefit from Stock Doctor, please feel free to share our referral link. We value your support.
Yeah, definitely. And until next time, have a happy, healthy, and prosperous week ahead.